How's the market? Well, let's find out. I'm Justin Miller, co-founder and principal at the Chong Miller Group. At the Chong Miller Group, we help our clients build wealth through real estate. We help our clients buy and sell property here in the Las Vegas Valley, whether that's primary residences, secondary, or investment properties. We can help you with your search, with your for a buyer or for a seller. We can help you with everything that you need around your real estate. All right, so this is the June market update for the Las Vegas Valley residential resale, single family homes. Let's go ahead and start looking at the numbers. So the thing to remember first is we always look backwards 1 month. So we're looking at a complete data set. So while it's June as I record this, we are looking at the May data. I will note, usually I pull the data on the 7th of every month. I try to be consistent about that so we get a kind of an equal snapshot across months because the database updates at different times. And sometimes we end up with a little bit of underreporting or overreporting early in the month. This month, at the beginning of June, I'm extremely busy and I apologize. I actually pulled the data on the 5th. So the data is not quite as stable. There may be some variation by the time that I actually get this posted, but these numbers are pretty good. They should be within 5 or 6 individual properties on any of the individual metrics as we look through this. All right, sale price for single family homes at the median resale single family in the Las Vegas Valley in May of 2023, $440,000. Now that's a pretty big difference from what we've had last month and the prior months. In fact, last month in April, that number was $425,000. We had a $15,000 jump over this past month. That is a 3.5% increase. And we've been going up since February. And so what that means is we're actually up $25,000 from February when we had bottomed in this correction, $25,000 less than this. So kind of interesting, right? That means we had actually gone down to 415. We're up to 440 now. Now we are down from May of last year, May of 2022. Remember, that was the absolute peak for this last housing cycle. We had gotten to 480,000 on resale single family residential in the Valley. So we're down from that $40,000 or 8.3%. Now it is kind of interesting that in the last couple months videos, we had seen that the percentage decrease from last year had actually been going up a little bit as we were making annual comparisons to sort of a 3-month steep part of the price increase curve in 2022. Well, even though we're now looking at the peak last year, we went up so strongly this year that our gap shrank from a little over 10% to 8.3% relative to last year. Now we're going to start seeing a dramatic change in our year-over-year comparisons going forward because prices last year after May started going down, and prices this year, there's not a good reason to believe they're going to be going down. They're going to continue to go up as we have every month since February. So what that means is that year-over-year gap, that percentage that we're below the year-over-year gap, that's going to start to fall as we look forward in time. And that's going to be kind of interesting. We'll probably exceed that 480,000 by the time we get to the end of 2023. But every month that we go forward, that annual comparison won't be to the peak. It'll be to decreasing prices last year. So that's why I say when you look at these year-over-year comparisons, you're not at the same point in the cycle. They're really important comparisons in the sense of a seasonality issue. Springs are stronger than winters. And so if we compare a spring number to a winter number, we're going to get something that's just a seasonal shadow. It's not necessarily an actual trend in the market. When we compare spring to spring, that gives us important information. But as we compare across cycles, that good annual information can become really deceptive. And because 2022 was a very weird year, first half going up steeply, second half coming down, I wouldn't say steeply, but coming down significantly, coming down about 12.5% in the second half of 2022. It makes the annual comparisons back to the year 2022 a little bit hard to interpret. And so that's why I spend a little time on this talking about it. We're in an uptrend now. Prices are going up. They've been going up since February. They're up $25,000 since February. We're up $15,000 month over month, and we're going to continue to see this trend going forward. And as we continue through the rest of the numbers, you'll see the evidence of why I'm suggesting that trend continues. All right, so we are up 3.5% month over month on price. Now, I also like to look at, for the single family homes, I like to look at median price per foot on houses it's sold, because that tells us something about the structure and the health of the market, how the market internal dynamics actually performed. So we were at $236 per foot in May for the median sale. That is up $0. We were at $236 in April as well. So perfectly flat. So even though median price went up by 3.5%, the price per foot did not go up at all. So that's an interesting thing to note. What that means is that we were seeing a lot of transactions in the middle of the market, and we were seeing, relatively speaking, fewer transactions at the top of the market. And so that's why price per foot was not going up. On the other hand, we were also seeing relatively few transactions in the bottom of the market, and that's why the median sale price still went higher even so. So it means that right now the middle of the market is really strong. The upper and lower portions, if you will, the top 20%, bottom 20% of the market are underperforming that middle 60% of the market. We also compare price per foot annually. So we're down $236, down 9.9% from the $262 per foot that we saw last year. Again, that suggested that at least in May of last year, we were seeing a lot more transaction volume sort of in the upper reaches of the market, those larger homes, larger properties, fancy pools, lots of really nice appliances, things that push price per foot higher. Those properties were selling at a greater pace than we were seeing in the middle or lower ends of the market last year. And that makes sense because the middle of the market was being hurt more significantly by those increasing interest rates than the top of the market. We've seen the top slow down, we've seen the bottom slow down, but the middle part of the market is doing really, really well right now. And so that's an encouraging sign, because if you've got that middle 60% of the market doing really well, it will end up pulling all the rest of the market along with it. It also tends to be the portion of the market that represents the greatest population of potential buyers and potential sellers. And so this is great news. This is really strong internal market dynamics that we're seeing right now. I'd be far more concerned if median price was going up and price per foot was going up steeply, because then what we're seeing is just very high end of the market strata, and that would be less good internally for the health of the market. All right, now having looked at price, what about the size of the market? How many transactions are actually taking place? How many houses actually sold in May? And you may remember last month I suggested the number was going to be higher because we had a really 2 months of really healthy gains in pending home sales, and that should actually translate to higher numbers of sales completing in May. And so we saw that. We had 2,127 single family homes close, sale completed, new owner of those properties. 2,127 in May of 2023. That is up 19.6% from the 1,778 that we saw completed closed transactions in April of this year. So almost 20%, 19.6% higher. That's a really significant increase in the number of closed transactions. And interestingly, this number, 2,127, is almost exactly 1,000 transactions greater than we saw at the really slow January of 2023. Now remember, Januaries are always depressed in terms of transactions because that's the slowest month of every year seasonally. So we're up, we would expect to be up seasonally, but we're also up really strongly across the market, way beyond normal seasonal trends. Now, last year again, an unusual year, we're down 25.1% from the 2842 that we saw in May, closed transactions we saw in May of 2022. Again, those annual comparisons are going to be deceptive. They're actually going to be deceptive all year long. They were deceptive in the first half because of strong growth we were seeing in the first half of 2022. And they'll be deceptive in the second half of this year. They'll look prettier, but they'll be deceptive because we saw really significant pullbacks in number of transactions last year. And we saw pullbacks at a decent clip, correction level clip in pricing last year. And so we're going to see this throughout all of the data when we're making those annual comparisons throughout the entirety of 2023. When we're doing annual comparisons next year relative to 2023, it'll be interesting because this year, so far starting out strong, but it looks like we should be seeing a good, steady, solid trend throughout 2023. As we've seen over the prior 4 months of this year, we've been moving pretty consistently in one direction. And so then annual comparisons 2024 to 2023 will start looking more like normal annual comparisons. We'll be able to say if the market's stronger or weaker. We'll be able to say if prices are going up or down relative to kind of a normal upward year that we're seeing in 2023. All right. Now, that's what did take place in May. What else took place in May? Well, we had new contract signings, pending contracts. These are buyer and seller make an agreement. They go into contract, they enter escrow, and they go through the purchasing process. So pending contracts often, usually, if they're intended to, always become closed contracts within a period of time, usually the following month. So if we get good pending numbers, that's a great indication about what's going forward in the market. So high pending numbers in one month lead to high sales numbers the following month. So our sales were great, but what about pending contracts? Contracts entered into 2,211. So that's a really decent number, and that's up 6.8% from the 2,071 pending contracts that we saw written in April. Now, that's actually more consequential than it may sound because we had a really big increase in pending contracts in March. And on top of that, we had a really significant increase in pending contracts in April. And so we're still going higher on pending contracts in the May data. So this is really good. This is a really healthy number for pending contracts. This suggests significant buyer growth in the marketplace. And so that's what we're looking for. We're always happy to see pending contracts go up. Now, I'm going to interrupt myself here to mention a data point that we'll get to in a couple minutes, which is back on market. We know we've been tracking since early 2020 really elevated numbers of back on market, meaning failed escrows, a pending contract that drops out. The property either is removed from the market and not sold, maybe it becomes a rental and doesn't sell, maybe it just simply goes back in the market and relists and has to sell again. Not good for a buyer, not good for a seller. Well, what's been causing high levels of back on market? It's mostly been bad appraisals, although last year, in the second half of last year, as prices were coming down, we saw appraisals getting relatively better to those low prices. But we saw significant increases in demands around inspections or due diligence or requests for repairs, however you want to call that. And so we saw inspection-related contract failures increase significantly. Well, I say that here because over this past month, I've been seeing a lot of increases in bad appraisals. And so I just want to talk about it for a second because they're really consequential. And they become consequential sort of in the process of buying or selling a home at the pending stage, right? One goes into a pending contract, one goes into escrow. And during escrow, you do an inspection on the property, you do a request for repairs. If any repairs are desired, the seller has the ability to negotiate about what repairs they may or may not do. You also have a couple of other contingencies. The biggest one is the appraisal process. So this is the point in time where the bank is going to hire on behalf of the buyer an appraiser, and the appraiser is going to go out to the property and appraise the property using their particular skills, I'll say, and algorithms to figure out what the appropriate value of the property is. Now, who is the appraisal designed to protect? Right? Because in some manner, we could think about the appraisal as being designed to prevent a buyer from paying too much. The seller may never learn what the appraisal is. So let's say one has a $500,000 house and the appraisal comes in at $550,000. The buyer has no obligation to tell the seller that the appraisal came in high, and probably would not bother sharing that information because it might cause a seller to feel upset about being in contract at a relatively low price. But if the appraisal comes in low, that causes problems. The bank is going to say, I won't lend more than the value, the appraised value of the property, obviously discounted then by the amount that the buyer is approved for. So let's say the appraisal came in on a $500,000 contract at $450,000. And let's say that the buyer was approved for a 90% loan-to-value mortgage. So they were thinking they were going to come in with a loan of $450,000, the buyer, and the buyer would bring in $50,000 of cash. Well, what happened is the appraisal came in at $450,000. The lender says, well, the house is worth less than we thought. We'll only lend 90% of the $450,000. So we'll only lend $405,000. Now, the problem is there's a contract at $500,000. The buyer could say, okay, that's fine. I'll come in with $95,000 instead of the $50,000 I thought I was going to, and I'll borrow the $405,000 the bank's now willing to lend instead of the $450,000 that I thought the bank would lend. Well, a lot of buyers do not have the extra $45,000 sitting in their pocket to be able to come up with this amount. So a buyer may go to the seller and try to negotiate, hey seller, the property you're selling me, turns out it's only worth $450,000. So let's rewrite the contract at $450,000, which would mean the buyer would only have to come up with $45,000, the bank would lend $405,000, but the seller would have to take a $50,000 price haircut on that sale. Well, a lot of sellers can't afford to do that. They owe a mortgage. They need money to buy their next property or retire, whatever they're going to fund with the money they're going to get from the sales proceeds. So a bad appraisal is bad on a seller who may not be able to do anything about it. Maybe the seller says, I can come down $10,000, but that still leaves a big gap for the buyer. The buyer may not be able to do it. So bad appraisal puts problematic pressure on a seller and on a buyer and can lead to collapse of the transaction, because the seller and the buyer may no longer be able to complete a transaction at the price that a bad appraisal suggests the house should be at. Who's protected? The bank. The bank is wanting to know that they're not lending too much money on a property. They don't want to lend $450,000 on a house that's only worth $450,000, because if something happens and the buyer can't pay and the bank needs to foreclose, they're going to lose money, at least transaction money, when they go to sell that property. So the appraisal is not really designed to help a buyer, and a bad appraisal harms a buyer. An appraisal is not designed to help a seller, and a bad appraisal hurts a seller. The appraisal is only designed to help a bank. That's it. And a bad appraisal means that the bank gets to, in a transaction that does not fail, they get to lower the amount of their exposure on a property. They get to lend less. On a transaction that fails, the bank gets to feel like, well, we don't have to lend on that one. We don't have to assume that risk. So I want you to think about that all the time. An appraisal is actually designed to help no one except a bank. Not buyer, not seller. So if you think as a buyer, well, I want the appraisal to come in low, I want a good deal, you risk losing the transaction. And you're not being helped in that process. You're actually being harmed in the process. If you're a seller, you always want the appraisal to come in on contract, and it can come in higher. It doesn't help you, it doesn't hurt you. It's kind of irrelevant. The bank, though, they go out of their way to make sure there's an appraisal done. And the bank doesn't really care the quality of the appraisal as long as it's skewed low. They don't want to take on the extra exposure. So they hire appraisers. The appraisal regulations say that appraisers should skew low, right? They're trying to get appraisers to do good jobs, but the incentive structure is simply that an appraiser rates an appraisal. If they do that, they get paid. The quality of the appraisal does not matter for the payment that the appraiser receives. So the incentive structure for appraisers, since the only ones who benefit are banks, are actually to appraise low. Not a lot low, because that would start to uncover the problem and we'd start to see better regulation, which might make life a little bit harder for appraisers. So appraisers skew their appraisals low. Well, this happened on a contract that I've got right now, a pending contract, should be closing in the next few days. We put the property onto market. We received 4 offers on that property over a 2-day period of time. And all of those offers were clustered pretty close to the list price on that property. That meant the list price was the market price, because we had these buyers coming in willing to pay at that price. The seller was willing to pay at that price. The definition of market price is the price at which buyers and sellers will meet and are willing to make the deal. That's the definition of a market price. Appraisals are supposed to uncover the market price. The challenge in real estate is you have a property which is definitionally unique. No 2 properties are exactly identical, even though many could be very similar. They might be comparable. And no 2 buyers are exactly identical. And so usually in a property transaction, you get 1 seller and 1 buyer, and they come to an agreement. Is that a market price? I would argue that's a market price, willing buyer, willing seller. The challenge is that sometimes a buyer or seller may have disparate levels of information and one may be able to take advantage of that knowledge gap preferentially over the other. And so having only one buyer and one seller, okay, there's some challenges to knowing whether that's actually a valid market price. If the seller and buyer are related, that's clearly not a market price transaction, even if the negotiation takes place at that level. So appraisers are supposed to ferret out information to find out unrelated buyer, unrelated seller, basically appropriate equal levels of knowledge. Is this then the market price that the contract was written at? Appraisers should use all of the information that's available to them, but they tend to skew conservatively, meaning lower, to use only information that they can look up objectively and find from prior sales. What that means is a prior sale is both a comparable, but it's also an anchor to an appraiser. They don't like moving higher than comparable sales, even if the market itself is moving higher. So we ended up in a situation, 4 offers from 4 separate buyers, all clustered at about the list price. We went into contract. The appraisal came back approximately 8% lower than the contract price. So we had to renegotiate. This was actually really hard. This is why I say, make sure you have an agent who can help you, whether you're on the buy side or the sell side. If you get a bad appraisal, you're going to have to be negotiating around that appraisal, or your transaction's collapsing. And when your transaction collapses, if you're a buyer, you start all over looking for new properties. Even though the one you loved was the one you loved, you can't get it because a seller can't correspond to what this appraisal is. If you're a seller, you're wanting to move on and do something else, and you can't if your transaction collapses. You have to figure out something else to do. Maybe try selling it again, maybe do something else. When appraisers are not willing to look at other market data, such as number of offers that are being made if there's multiple offers, the clustering of those, prices in those offers, there's something broken in the appraisal process. We get bad appraisals, and that causes some of these pending contracts, a substantial share since early 2020, a substantial share of these contracts to collapse. And that's a disservice to everyone in the market. So that's my comment about appraisals, and what you need to be doing to try to protect yourself is you need to be trying to do everything you can to make sure appraisals come in as good as possible. And you need to make sure you have agents who are knowledgeable and able to do everything that they can to make sure that appraisals come in as close as possible, and that there are backup plans in case the appraisals are not coming in well. Okay, and since I've been talking about bad appraisals and the impact of those bad appraisals being back on markets, let me just give you that back on market statistic right now. In May of 2023, in the Las Vegas Valley Single Family Resale Residential, 819 contracts collapsed. That's a big number, right? Not only is it a big number, it's 27.8% of contracts that were written that should have closed probably in the month of May, but maybe April and they were held over for a little while. Maybe June, they failed a little bit early. 27.8% of contracts failed. 819 of them. Now that is actually a slight improvement from what we had in April, when 28.9% of contracts failed. The reason for failures is prices going up. The reason for failures of contracts more often than not is bad appraisals. There are other reasons. A buyer could have lost a job, or a buyer could have gotten cold feet, or a seller does not get the transfer that they thought they were going to get and can no longer sell the house. Or there's an inspection problem, and buyer and seller cannot reach agreement on an inspection. So there's a number of reasons, but normal back on market is going to be in the 10 to 15% range. We're running double that. And we have been running double that since early 2020. Make sure you're doing what you can to protect yourself from back on market problems, the majority of which are being generated from bad appraisals. Make sure you're talking to agents to know how they deal with this kind of issue and how they can help you with this kind of issue. So now let's turn our attention to the supply side of the market, right? We've been talking about contracts written, which means there's a buyer. We've been talking about sales, which means there's a buyer. So these are demand side issues. But inventory is a supply side issue. It's how many houses are listed for resale. And every month I comment about inventory, but every month since October of 2020, I've actually started harping on the inventory issue because we've been seeing inventory problems. Now, inventory problems could be we've got way too much, or inventory problems could be we don't have enough. Well, October of 2020, we saw inventory fall below, for the first time I'd ever seen, fall below 5,000 houses, single family resale houses listed for sale. And I commented that declining inventory level at that time was going to start pushing prices higher because you don't have enough houses to meet the demand that's in the environment. And by the way, throughout 2021, we saw not just inventory coming down, we saw increasing numbers of transactions. 2021 was a record year for number of transactions. How do we get that? Properties hit the market and they went into contract immediately. They never really sat in inventory. During the year of 2021, we were seeing that a lot. Well, that meant that prices were being pushed higher. And 2021 was a demand-based increase in prices. How do I know? Because even as prices were going higher, more and more transactions were taking place. That's how we can tell whether or not we've got a supply constraint that's pushing prices higher or a demand constraint that's pushing prices higher. In 2021, we had both, but demand was overwhelmingly larger in consequence than supply was. Well, in 2022, we saw in the first half that same demand dynamic. In the second half of the year, we saw demand drop off. But I had speculated that was a transitory issue associated with very steep increases in interest rates and buyers having to relearn what they could afford in the particular market. And in 2023, I had suggested that latent demand was going to rematerialize, and we needed to have good supply in order to meet that, to be able to hold prices, or we'd start to see prices continue to go higher and higher. And that's what we've been seeing so far this year. So what did May inventory look like? Because we had a $15,000 price increase at the median in May. Well, inventory looked problematic. Inventory not only had gone below 5,000, but as I'd been suggesting, inventory was going to continue to trend down, and we actually went below 4,000. And I've seen this only during a couple of months in 2021, 2022. We were at 3,766 single-family homes for sale in the Las Vegas Valley at the end of May. That's down 16% from the 4,410 that were listed for sale at the end of April. That's a really big hit to inventory. And I've been not just predicting this, I've been pointing to exactly the indicators that were driving this issue and commenting this was going to continue. May is the 8th month in a very strong downtrend in inventory. We've seen inventory numbers just kind of become not just depleted, but decimated. This is a really significant thing to keep an eye on. Now, this actually we saw more inventory last year. You may remember in the prior 2 months videos, I'd suggested inventory was going up last year in the March and April timeframe. So inventory last year in May, 4,995. So we're down 24.6% from the inventory we saw in May. Now, last year, there were a lot of people who were super concerned. Inventory was on the high side, and that's where the problem was. Well, inventory had actually peaked in September of last year, and it peaked at 9,658. We're down 61% from that. Now, there's another way to look at this number, and that is months supply. And sometimes that's a little easier to look at because it gives you a kind of an impact statement on these numbers. And so they're not just random numbers from the universe describing numbers of houses. I had been suggesting over the past 2 months, starting in March, that we were likely to see inventory in May come all the way down to 2 months, which would mean effectively 8 weeks worth of inventory sitting in the market. If no new inventory came in 8 weeks, every single house would be off the market. That would be the end of it. Obviously, the market doesn't work that way. We get new inventory coming in through new listings we'll look at in a minute. We get stuff going out through sales. And there's some stuff that it's never going to sell because it's just in such deplorable condition, or it's way overpriced and nobody's going to even bother making a bid on it. So 2 months, I had suggested in March, I was suggesting the trend we were on would take us to 2 months worth of inventory, 2.0 months worth of inventory at the end of May. Well, I was wrong. It took us to 2.1 months worth of inventory. So if we think of a tenth of a month, that's 3 days. So it's not 8 weeks, it's 8 weeks and 3 days worth of inventory. That's all we have sitting in this market at the end of May. Normal balanced market, 5 to 6 months. We're at a third, approximately, of a normal balanced market in terms of inventory. Now, that's down from 2.5 months worth of inventory at the end of April. Right? Inventory is just being churned through. It's being depleted. If we continue at this pace, we're going to get lower and we'll be below 2 months worth of inventory. This is actually really problematic. So we've got 2/3 of normal inventory in the market. We've got real sales taking place, and we've got real pending contracts being written. Buyers are absolutely out there looking for properties, trying to go into contract on properties, and there's not enough inventory. 2 months is just not enough inventory. And if we think about this in terms of, again, sort of, wow, we went below 4,000 houses. This has only happened in 3 months during 2021 and 2022 that we went below 4,000 houses for sale. We're really, really tight on inventory. So inventory is replenished as we get newly listed resale properties coming into the market. Somebody decides, oh, I want to sell my house, and so they list their house. It's newly listed and goes into the inventory. Well, this number in March and April, incredibly weak. Actually, both months came down. Counter-seasonally, we normally see the strongest build in new listings happening in March and April. I had suggested, I was surprised by that a little bit. I had thought that May and June were going to be significant inventory build months through new listings this year. This is the only number that's caught me off guard this month, because we did get an inventory build, but it was or a new listing build, but it was small. In May, we got 2,468 newly listed resale houses coming into the market. That was up 4.7% from the 2,358 newly listed resale houses coming into the market in April. Now, that sounds good, right? We're getting more new listings. The problem is if we eliminate the time period November 2022 through April of 2023, we've not seen new listings this low except in the month of December for any years in the past 15 years. This is stunningly low numbers of new houses coming into the market. Now, why Decembers? Decembers are always seasonally the slowest month for new listings. And that's part of the reason why January is the slowest month for transactions, right? If you look at the chart, every single month you see this great big, every single year you see this great big dip in new listings in the month of December. So December new listings, those should be the lowest of the year, and they are. And with the exception of November through April of this past several months, we've not seen new listings this low except in December's. So that we got a 4.7% build, great, but pretty close to inconsequential. That means that in June, we may be seeing new listings come up, which I think that we will be, but it means that inventory in June is likely to actually fall even further. And of course, low inventory means there's less out there for all those buyers to look at, less out there for all those buyers to compete against each other on, less out there for all those buyers to write contracts on, which means that all those buyers, because clearly there's demand in the market, will be pushing prices still higher. And so we saw through May really good pending home sale numbers, right? They were up after being up strongly in March and strongly in April. They were still up again in May. Now, we could see a little bit of a lull here at the beginning of June, but I think that June's overall sales numbers will be going up. I think June's overall pending numbers will be going up, especially if we see interest rates coming down further, as I'm predicting that they will. And we're going to see prices continuing to go higher. And we're also going to see a continuation of problematic appraisals in this market, which will be keeping back on market numbers higher. So if you're a buyer, if you're a seller, please make sure you're talking to real estate agents, to interview them to find out what they know, what they can do when challenges arise in transactions. At the Chong Miller Group, we help people build wealth through real estate. We help people buy and sell homes. I'm Justin Miller, and I look forward to seeing you in the next video. Thank you. Bye-bye.